Hello, everyone, and thank you for joining me. Let's talk about one of the most overlooked ways to build long-term, tax-free wealth. And not just that, but also accomplishing the elusive goal of also reducing current taxes. Now, before you stop me and say, I thought I had to choose between reducing current taxes or future taxes when saving for retirement. This is a rare scenario where you can have your cake and eat it too. I'm talking about the health savings account, otherwise known as the HSA. This is a special type of account where money goes in with an upfront tax deduction, grows tax deferred, and when used for qualifying medical expenses, comes out tax free. Let me reiterate that. No tax on the contributions, earnings, or withdrawals. So what's the catch? You and your family's eligibility to participate in an HSA is determined by health insurance coverage. To be eligible, you must be in a high deductible health plan and covered by no other health insurance plans. Now, depending on your and your family's health insurance needs over the course of time, or even in any one given year, this could mean that the insurance coverage requirement is not worth the trade-off for the HSA. But for those where a high deductible plan is the right choice, the benefits can be tremendous. Let's start with the current tax reduction. Outside of retirement plan contributions, the HSA is arguably the best way for high-earning W-2 employees to reduce current income taxes. In 2026, individuals contribute $4,400 to an HSA, and those on a family plan can contribute up to $8,750. If you're 55 and older and not on Medicare, this can be up to $9,750. But before contributing, ensure you know if your employer is putting in money as well, and if so, how much, because those employer contributions count towards the total. The second benefit is tax-deferred earnings. Like a retirement plan, an HSA allows the ability to invest your funds for growth. Oftentimes, you may be required to keep a portion in cash, but once that limit is met, you can put the surplus to work for you and your family. And like a retirement plan, these funds don't have any current tax implications, meaning you keep what you earn. Now for the best part, the potential for tax-free withdrawals. HSAs are designed to be used for health-related expenses, and in order to qualify for tax-free treatment, the withdrawal must be for a qualified medical expense. But that doesn't mean you need to withdraw the funds in the year of the expense. These expenses can be reimbursed if or when you need the money down the line, so long as you have the receipts to back up the claim. This lets your investments compound and grow for you over the long run. It can also be an incredible tool in retirement. With the average medical expenses for a retired couple hovering around $350,000 through retirement, the difference between paying no taxes on the expenses and taxes on the expenses can be a game changer. But just like everything else in financial planning, whether or not this is right for you and your family depends on a few critical qualifiers up front. Start by evaluating whether you have a high deductible plan as an option for coverage. If you do, does it make sense for your family? The nice part about this is that it can be evaluated annually during open enrollment. And if it does make sense, how do I ensure that it's part of my overall coordinated strategy? At Priscillium, we are constantly helping our clients to answer these questions and evaluate not only their benefit packages through their employer, but how we can coordinate a strategy using them to, well, their benefit. Thank you for watching, and until next time.